Hi. When it comes to divisional performance evaluation in the subject performance management, there is one common statement that says ROI, return on investment, may result in dysfunctional decisions, which can be avoided by the use of residual income. Let me explain you a couple of instances where this statement applies. Look at this example. Let me take division alpha of a company. It currently has an investment of, say, $2 million, and it currently maintains an operating profit of say $420,000. This is their forecast for next year. Whereas the group policy, this is one division we are talking about, alpha, so it is under a group of companies. The group policy target ROI is 15%. Divisional managers are rewarded based on ROI of their divisions, which means if they have a high ROI, they get high return, high bonus, high incentives. This division alpha is considering a new project which requires an investment of $500,000, and it will give a annual profit of $90,000. Question is, will the division alpha manager accept this project? Let's analyze. So how do we analyze? Now let's think like the manager. Division alpha has a current ROI, return on investment, of how much? Profit of 420,000 divided by investment of 2 million. That gives 21 percentage ROI. So currently the manager maintains an ROI of 21% for this division. Good. What will happen if he accepts the project? After the project, if the project or ROI, if the project is accepted, how much will be their profit? Already they have this much profit. The project will add this much of profit. This is going to be the total profit divided by total investment. This is the investment they have now, plus the investment in the new project is this, altogether the new investment. Get it as a percentage ROI. Percentage 20.4. Now you can see if he doesn't accept the project, he will have an ROI of 21%. If he accepts the project, it is going to be 20.4%. What do we see here? ROI decreases if the project is accepted, which the manager will not like, because manager's performance is rewarded, or manager's performance is evaluated based on ROI. So if ROI is the performance criteria, this project brings down the ROI, it reduces the ROI, manager should not accept it. So alpha manager will reject this project. There is nothing wrong in what he is doing. He is absolutely right in his decision. Okay, let's do some further analysis now. let's do some further analysis. What analysis I'm going to do? What is the project's standalone ROI? Just look at the project only. Project gives you 90,000 profit and it takes an investment of 500,000. The ROI of the project is 18%. Keeping this division aside, think from group's point of view. Group has a target ROI of 15%. This project has an ROI of 18%. Doesn't it look like a good project? So, from the group point of view, the project is good. It should be accepted. Why is that? Group has defined a target ROI based on the investor's expectation. They have decided anything above 15% is good. So even if you get 15.1% return from a project, for the investors it is satisfying. You can invest in that. This project has 18% ROI. It looks good. Investors will be happy. So from group point of view, this is a good project. But what did the manager decide? Manager decided to reject this project. Do you see a conflict here? Good project, manager is rejecting. This is what we call dysfunctional decision. A project that is good or that is acceptable from the group point of view is being rejected by the divisional manager. This is dysfunctional decision. So what is the meaning of dysfunctional decision? The divisional manager's decisions are not aligned with the group's policy, group's expectations. Who is wrong here? It's not the manager. What is wrong? The use of ROI is the problem. You gave ROI as the performance criteria. That is why this resulted in. Same information, let's analyze now. If, okay, same data, will the division alpha's manager accept this project if residual income is used as the performance criteria? I change the performance criteria. Now the manager is going to be rewarded based on residual income, not based on ROI. Okay, you know how to find residual income. Take the divisional profit, which is this much. Take the imputed interest. Imputed interest means capital employed multiplied by cost of capital. Let's assume here the required return projects. Where is that? Required target ROI. Let's assume this is the cost of capital of the company. Let's assume. So 15% is the cost of capital. What's the meaning of this 300,000? To meet the investor's requirement, investor's expectations, you need to make 300,000 profit. The division currently makes a profit of 420,000. How much extra residual income? 120,000 residual income they are making now, currently. After the project has been accepted, how much will be their profit? Now 420, project gives 90, 510. How much will be the imputed interest? That means the required return at the investment. Altogether, this much is the investment. On this investment, they want 15% return. Now, how much is the residual income? Same formula, drag it. Right. Can you see residual income increased? So, if residual income is used as the performance measure, let me say, if RI is the performance measure, performance criterion, the divisional manager will accept the project. Why? As it increases the RI. See, it increases the overall RI. So he's going to get more bonus. And in this case, this decision is in line with the group decision because group also likes this project. From group policy, this is good project. So let me say this decision is in line with the group objective. You understand? So this is why I say, look at this example once again. There's a new project. If ROI is the divisional performance measure, the manager will not accept this because it's going to reduce the ROI. 21 becomes 20.4. But group point of view, it's a good project. Good project, rejected, dysfunctional decision. How do we avoid this? In this case, instead of using ROI as the performance measure, if we used RI, residual income, as the performance measure, look at this, residual income increased. So manager will accept it. This is the original statement we mentioned here. What? ROI may result in dysfunctional decisions. It's not always, some instances. That's why I said may. It may result in dysfunctional decisions, and such dysfunctional decisions can be avoided if residual income is used as the performance measure.